So I spent 20 years in the hedge fund industry. Very fortunate to work for one of the largest hedge funds, managing a 120 billion financing book. No large asset manager will bring their assets, their portfolio, their liquidity on-chain on a public network.
You need to really build good products. You really need to build use cases. You really need to have a good token distribution.
Let's start with some introductions. My name is Nikita Sachdev. I'm the CEO and founder of Luna PR. We're a PR agency headquartered in Dubai with offices in London and New York, focused on Web3 and disruptive tech.
Hi, Jan Klesla. I'm head of the project called Deus. That's a European financial infrastructure based in Brussels, EU, and working globally. Thank you.
Thank you. Afternoon, everyone. My name is Ultan Miller. I'm the founder and CEO of Hecto Finance. We are tokenizing pre-IPO assets on Canton. Think SpaceX, OpenAI, Tether.
Hi, everyone. My name is Anastasiia. I'm from Peanut Trade. Very happy to co-host you here tonight with Gamma Prime, our amazing partners. And Peanut Trade is a proprietary fund at core, as well as the market makers that cover both centralized and decentralized exchanges. So if you're ever looking for help with market making, let me know.
Good evening, everyone. This is Vineet here. I'm the CEO at Sigma Capital. We are a $100 million fund based out of the region. I've been investing in the last 4 or 5 years, over 300 plus investments so far and counting.
Hello, everyone. I'm Fahmi Syed. I'm the president and janitor at Midnight Foundation. We're bringing rational privacy to the blockchains to usher in a new era of tokenization.
Hi, everyone. My name is Faraj. I'm leading Stellar Foundation's efforts in the Middle East. I'm senior advisor for the Middle East. Stellar is blockchain focused on the payments since 2014, partnering with large institutions and bringing payment rails into the everyday financial services. I'm also founder of CrossCurve, which is cross-chain infrastructure, and Crypto Executives, which is largest in the space community of C-level executives.
Awesome. Amazing panelists here. So our topic today is about tokenizing the world. And funny enough, this is my third panel today, and it's all been about RWAs. So it seems like we really are on a mission to tokenize the world. However, the reality is a lot more nuanced. This could be the next trillion-dollar wave. However, we see issues with fragmentation, with liquidity, and most important, mass adoption, in my opinion. So what do you guys see as the biggest hamper into actually getting people to adopt and this becoming the next wave?
I'll go first. So I spent 20 years in the hedge fund industry. Very fortunate to work for one of the largest hedge funds, managing a 120 billion financing book. We found price discovery, liquidity discovery, execution, settlement, move margin. Nobody but my fund, my counterparty, and the custodian knew. You can't do that on a blockchain today. Blockchains, by nature, are transparent to give you a truth layer. But that was an oversight when Bitcoin first came to the market. This truth engine that we all around the infrastructure of blockchain relied on transparency to give you a solution around confirmation of asset ownership, no double spends and things of that nature. No large asset manager will bring their assets, their portfolio, their liquidity on-chain on a public network. If I look across this, can I just ask the audience just to participate very briefly with me? If you're willing to go outside this room and share your name or where you work with anybody else in this room, can you just raise your hand? If you're willing to do that, because we're all here to network. So a lot of private people here, but some are willing to do that. But you're not willing to tell them what your salary is and what you earn and what you hold. That's what happens on every blockchain. And private blockchains and solutions like those are siloed and create fragmentation and no liquidity. So you need programmable privacy on a blockchain with selective disclosures that allow, within a permissionless network, to create solutions around bringing real-world liquidity, assets, and the big players into this market. And if you can do that, and that's what Midnight is doing, then I think you get to a place where you bring $1 trillion of assets into blockchains.
So for me, I think the problem is much bigger. Building a website is easy. Anybody in the world can build it. And in India, 15 years back, everyone was building a website. How do you get users on board is critical. So when we talk about RWA, you know, every kid over here wants to tokenize a building. That's a 5-minute Open Zeppelin smart contract. How will you get millions of people to buy that token is important. And DBS in Singapore ran basically tokenized a few real estate, but no one was there to buy. You know, when you say I'm going to tokenize US Treasury, who is buying that? So I think the problem is more on the adoption side, where people have to land up in Africa and land up in Latin America and give people an option to earn a US dollar stable yield, which no one's doing because everyone's in New York and Dubai and Singapore and having, you know, crypto is more than launching a token. Real adoption comes when you go on the ground and get users to utilize your product, which I don't see at the moment, but it's a hype word that's going around.
Vineet, on that note, how do we differentiate between people that are buying the token for speculation and people that are actually want to participate in the RWA ecosystem?
So as of now, maximum people that I see are actually doing it for speculation, but it's not bad. You know, speculation drives adoption. When you look at these companies, you ask them what is the revenue model. Technically, none of them have, you know. There are two companies like Ondo Finance, for example. I've just invested in Open Eden. They, you know, there are companies which have $200-300 million or $1 billion in revenue, TVL. But most of the other guys are just building a product, going to investors and raising capital and hoping that there's no business model as such. So I think when you look at a founder, you figure out what the end objective is. So that's why I'm a bit scared, but still there are good projects that you can invest in.
Yeah, I couldn't agree more, actually. Tokenization of real estate, more, really? Do we need yet another block of flats in Dubai tokenized? Let's bring assets to the table that people want to invest in, right? Rather than just layering or mirroring what already exists. I think fundamentally, it's about democratizing access to something that people want. And that's why we focus on the pre-IPO asset class. It's something inaccessible to people both in traditional finance and on the blockchain. So there is that need.
Something that people want and also something that's more liquid. Anastasiia, how do you do all assets really need to be tokenized?
Yeah, so from a market making perspective, the issue that we see with tokenizing real world assets, whatever they are, stocks, bonds, or whether it's an apartment in Dubai, is that we need to put a lot more liquidity into DEXs. So that would be one. And there is different debates in terms of what would be the best mechanism to put all that liquidity, but they all have their pros and cons, right? But the issue that we come to is actually fixing the inefficiencies. So when you mix TradFi and Web3 pricing, stocks are traded at a very limited time during the day. So somebody is going to have to fix that arbitrage gap between somebody's going to have to do it, and also, as I mentioned, a lot more liquidity needs to be on DEX in order to guarantee this sort of seamless trading experience for retail traders. But this is not even the only issue. One of the bigger issues is that do we have enough retail traders? This is something that's also been mentioned today. And in order for that to happen, the only answer is that you need to really build good products. You really need to build use cases. You really need to have a good token distribution. That's what happens with a lot of RWA protocols, because they seem to have a good community that they create a point system for, where they swap and they bridge and they do whatever, right? And then at the moment, once their TG happens, it flops. Nobody uses it anymore. There is not that much hype around it. And there we are. We're there with a dead token. And that's not only RWA, that's actually most of the tokens on the market.
Jan, what are your thoughts on the biggest barriers to mass adoption of real-world assets?
Well, I can agree with a lot of what was said, but I would build on what was said on the last panel. It's a lack of connection to the real economy. Actually, we can see that traditional finance world and the blockchain finance world are converging, but there's still no link. There's a missing infrastructure to connect it with the real guys, with the SMEs, with the companies, with the real entrepreneurs, like little ones. That is what basically we are trying to build in Europe, but actually, of course, it has to be heavily regulated, blah, 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 and everything we actually, I'm a lawyer, so I can skip all the laws, and we heard about all the regulations today, but what is important is to build trust for the little guys. Honestly, they don't have to really know there is any blockchain. It has to be a good business for them. It has to open a new business opportunities for them. It has to be cheaper, more efficient. Otherwise, they will go to the bank and get a mostly bad deal or no deal. So we need, as an industry, we need to serve the real economy, the real SMEs, the famous Mittelstand in Germany or any other SME in the world, and we need to open this opportunity, because it's a huge opportunity, to any investor globally.
Yeah, well, thanks for that. Ultan, you're building pre-IPO, you're tokenizing pre-IPOs on Canton, you said earlier. Yeah. I was just on a panel with them before this. However, your fellow panelists here, you have other L1s. You're sitting here with Stellar and Midnight. So what is actually going to win? Is it the purpose-built layer ones or the more general purpose, the more general layer ones? Because Stellar has been doing RWAs before RWAs was a thing. So why Canton?
Well, I didn't realize you wanted to start a fist fight on the stage.
Come on, we're coming to the end of the day. We want to wake up the audience a little bit.
We'll keep it calm. So I think if you look at the top 100 and you think about what has launched in the last year or two that's exciting, that's novel, that's different, I would really hold up two projects. The first would be BitTensor, purpose-built L1 designed for a very specific use case, right? And the second is Canton, purpose-built L1 designed for a very specific use case. Monad, Mega ETH, so many of these chains that are coming out offering, cheaper, faster. I think perhaps they can get some market share, but really we're at the point of maturity now where, as we've discussed on the panel already, it's specialized features that will bring these assets online. And also, not only that, it's novel economic systems. Look at the economic innovation behind the subnet design of BitTensor. Look at the huge numbers of incentives that are being distributed by Canton. They can only do that because of their unique consensus model, right? Other blockchains are simply overpaying for security with proof of work or proof of stake. They found a way to alternatively distribute the lion's share of these incentives, not to node operators, but actually to the developers, right? To the banks or the payments institutions who are going to build that financial infrastructure. So I'm very much on the side of purpose-built L1. Hope we don't start too much of a war, but yeah, that's where I land.
Fahmi, you guys just going to take that?
Yeah, absolutely. Thanks for the question. Stellar was in the RWA space way before of this being fashionable. So it first tokenized Franklin Templeton, which is one of the largest in the space institutional asset managers, with 1.7 trillion under management now. So it tokenized the money market fund back in 2018. And back then it was very dangerous. SEC approvals for Franklin Templeton for peer-to-peer transfer took 1.5 years, which it actually received. There is a lot of proper development was done on chain for additional blockchain tools that could be used by not only Franklin Templeton, but all others use on this permissionless chain. And this actually brings a lot of utility to the new developers that would like to utilize institutional grade possibilities of the chain. So Stellar now is having first of all, it was built with a payments focused idea. So it also is having a lot of compliance features built in. such as asset clawbacks, such as asset freezes by the issuers. And most importantly, it has a very vibrant developing community. So the developers in far remote areas, which actually has a real pain of being underserved by banking industry, have the ability to build on permissionless chain the tools and apps that directly help them and help their customers to achieve everyday financial services and achieve their needs. So any permission chain up until now, like take it R3 by Corda, that works for very different governments, a lot of Hedera type permissioned initiatives were there initially. It didn't succeed because it doesn't take into account this large developer community that is just building on different parts of the world and using your infrastructure as a base layer. So for us as a foundation, what we need to do is we need to improve this base layer with privacy elements, with more compliance elements as well, and in general make sure that it stays as low cost, fast, and very reliable. So as long as you have this reliable nature, like for example, Stellar's uptime is 99.99% in last 10 years. So for an institution, it's very important that they will actually trust their mission critical banking services, for example, with you. And they have this trust in you that you will stay uptime. So yeah, I think that there's always a debate, which is better, permissionless or permissioned. But I believe that as a base layer for financial services, it has to be permissionless to allow for innovation. And then you can build on top different permissioned components, different compliance tools, etc., that will allow you to have higher privacy, etc., etc.
Yeah, I'm going to agree with Faraj. We're in blockchain because it's decentralized. So Ultan, I'm glad that Canton allowed you into their network because you need their permission, right?
It's true. We're lucky to have a node. Thank you.
Bitcoin came about a week, the white paper of Bitcoin was released a week after Lehman's and the financial crisis. Lehman's went bankrupt. I had about $50 million of margin sat at Lehman's that I had to leave behind because of one position, and I couldn't get the money out on the Friday before they collapsed. Because your cash was an IOU. The banks decided your hard-earned salary, your assets, they managed, they controlled. So why would you go back to a permission network? I have nothing against Canton, I think they're great. But the whole idea and premise of Bitcoin was that suddenly you had disintermediation, direct ownership of your asset, borderless transactions, no censorship. So permissionless networks make that possible. And Stellar have done a great job. And congratulations on managing the transfer agency for Franklin Templeton. But when we talk about liquidity, forget about use cases. The UX doesn't matter if you can't bring real assets, real liquidity. And the number one asset in the world is data. Data is money. Data allows large financial institutions, large hedge funds like the one I used to work at, to be monetized and to make returns for their wealthy investors. And why would you put that data on a public chain? So everybody sees everything you do. Every time there's a bot, a trading bot that creates alpha, what happens? Everybody follows that trade. The alpha is eroded. So you need a solution where you can protect your data and your metadata on chain. So your assets, your data sits off chain. You then present that on chain as a proof, and through Midnight, we have smart contracts that allow selective disclosure of those proofs to your counterpart. So you can make a regulated permission pool within a permissionless network. So if a large asset manager wants to come and speak to us, which many are, then they can issue their funds on the network. But democratization is not the value of putting an asset on a blockchain. The value is collateralization. If you take a hedge fund unit, you cannot get margin on that unless you have access to large private wealth managers or investment banks like I used to. But if you can take that hedge fund unit, put it on a network like Midnight, and selectively disclose the underlying portfolio of equities, fixed income, then suddenly you get leverage and lending capabilities that do not exist today for the general public. You can provide proof of all your collateral across all your counterparties without disclosing any sensitive information. But it's more than assets and financial assets. Healthcare data is coming on midnight in the preview. Monetizing that and how that gives benefits to the clinics, who then get a new revenue source, which allows them to reduce the cost of their premiums and insurance costs to their clients. Lower cost brings more patients, more data, more proofs on chain, more revenue through that. Forensic, supply chain. There's so many use cases around data and how you monetize that. That's the asset that goes on chain. That's the asset you need to protect. That's where you make money.
Okay, so I think permission versus permissionless is a panel discussion on its own. But on that note, and then after this, I want to talk about the investment side because, Vineet, you're one of the best investors that I've met, and I have some questions for you as well. But before I move on to that, we touch base a lot on Franklin Templeton and what happens when these large companies and BlackRock get into the space and decide that they want to start actually properly get into RWA and start tokenizing assets. What happens to crypto native platforms?
I believe that when this big fish is entering the market, I believe that this creates a big liquidity injection into this into the ecosystems, which can be then used by developers to create like different type of DeFi instruments on top of them. So I don't believe that there is those institutions by entering into crypto will have a negative effect. The innovation is driven by young entrepreneurs that would like to serve their customers. They're way closer to the customers. They know what actually is there. And the yield-seeking people that are, for example, utilizing Benji tokens could be beneficiaries of those small and medium-sized companies that are trying to serve those large liquidity positions on chain. So I believe that this is actually a positive thing that BlackRock and Franklin Templeton and large asset issuers are moving on chain.
Anastasiia, you were going to say something.
Yeah, I just think it's amazing how in such a short span of time we went from crypto being used as a mean of payment for illicit activities and whatnot to now actually BlackRock being a massive topic in this conversation. So I think it's amazing, and I think it's a very natural, organic development of the industry as a whole. That's something that happened to TradFi. That's something that we're seeing now is happening to Web3. So nothing. I understand the economic implementation that it all brings, but it's also happening to TradFi. So why should we be different in that sense? Also, if you ask any sort of founder, if they are willing to be bought out or acquired at least a part by BlackRock, I'm sure that everybody's going to be happy about it. So that's just the truth of it.
So I have a very controversial view here. You know, when everyone talks about BlackRock coming here, Fidelity coming here, I've been in New York in August, and it was the busiest August in New York, because everyone knew that everyone's making a commission on digital asset treasuries. And Q1, it will all, after their commissions are paid off, it all comes down. So my problem with institutions is that, you know, every cycle they say institutions are coming, this time is different. But then Bitcoin goes to 78K. The problem is not that institutions are there. The problem is I've been asking fund managers in New York, how many of you, suppose there's a market downturn, that means suppose the world crashes tomorrow, what will you sell? Bitcoin, your house, or gold? And none of these fund managers have said that I'll sell my gold or I'll sell my house. They all said we'll sell Bitcoin because we don't understand what Bitcoin represents. We are selling it just because people want to buy it. Bankers, fund managers, New York guys. That's my concern with institutional.
Well, also because it's quicker to do so. And so, you know, Vineet, you've been in the space for so long, right? Like you've created massive upside for some of your LPs. When we're talking about RWAs, T-bills and real estate aren't as exciting to some of those LPs. So where is the big upside here?
So for me, where do I see my upside? For me, you know, my last two funds were, okay, put money in a token, it lists on Binance, we do 100x, all go home happy, and buy a car, Ferrari. I think how I'm changing my fund, and this is where I see the opportunity. There are three things that are missing in crypto space. One is there's no traditional liquidity coming in. That means family offices are not deploying into these crypto assets, the real $50, $100 million, not the $1, $2 million. The second thing is there's no adoption coming in. I have a game where $50 million has been invested by A16Z and Cathy Woods, but they are not tied up with Reliance Mobile in India to get them $50 million. So I'm getting capital, I'm getting partnerships, and I'm getting real entrepreneurs. Hackathons get kids who just want a $50,000. But you really need entrepreneurs who go through Y Combinators and Alliance DAOs to build these companies. So for me, I think that is where real thing has to come. Building a website or a RWA smart contract is not the right thing. How do I see to it that BlackRock actually invests in a product like OpenEden, which has $200 million in AUM? Because that's where this whole thing will grow. Otherwise, we'll just play token, pump tokens, and then it's a bear market again.
So just to add to that, I agree there's no liquidity. If you try and trade any crypto asset, except for maybe Bitcoin and Ethereum and Solana, there is no liquidity because institutional investment who have the liquidity, let's be honest, if you're here for Abu Dhabi Finance Week, 1% there is more than most of the liquidity in crypto. They are the whales in the room, and we don't discuss it. Yeah. And those investors, the family offices with $50 million tickets, $25 million, they need KYB, KYC. Correct. They need privacy. How many blockchains offer that solution? Almost none. Maybe some private ones, but you need permission. But if you want to build permissionless access without creating silos, then we are speaking to, this morning I had a breakfast with the head of digital assets and innovation at one of the top 3 traditional custodians. So I won't say any lower than that because you'll figure out which one, but one of the top 3. And she said to me that they are working with permissionless chains because they recognize that silos do not work in permission chains. But if they're going to come, they need a network that can enable them, all their partners, to gateway into transactions through permissions. Because that's what you do with a bank, a hedge fund, an asset manager, a family office. The first thing they do is KYB, KYC with a bank like Goldman Sachs, Morgan Stanley. They're effectively your DApp on-chain for the US federal system. They are your trust mechanism to allow you to trade into assets, whether it's equities, fixed income, or cash. We can do away with that if you can build a smart contract that gives you the truth about proof of identity, proof of accreditation, proof of healthcare, whatever it may be. And then from that, you get access to tokenized assets. Many tokenizations happen, but the KYC, KYB happens off-chain. And then, if you are US gated, they trade it off-chain until it passes the relevant duration and comes on-chain. That is not decentralized. That is not blockchain. That is a halfway house. If you're going to do it properly, you need to bring identity, selective disclosure, proofs on-chain in a way that your assets, your data, your metadata, the who you are, the what you are, the when you are, is fully protected all the time, just like in traditional rails. If you don't believe that, none of that liquidity is coming.
So once we've checked the infrastructure, the next step, we still need the liquidity. How do we build demand? Where are the users coming from? Ultan, who's going to buy your pre-IPO, who's going to buy into your RWA product?
Well, I would say broadly speaking, you have 2 kinds of assets. There are ones that have liquidity off-chain already, and there are ones that don't. For example, Vineet earlier mentioned Ondo. What they've succeeded in doing is allowing people on-chain to access the off-chain liquidity. So if you mint, let's say, a tokenized NVIDIA from Ondo, you'll find there's no Uniswap pool with any substance, right? But you can buy or sell in significant volume through Ondo because they're tapping the off-chain liquidity, right? So that's one group. And then the second group is assets that are illiquid off-chain and also currently illiquid on-chain. And the question is for those assets, can blockchain solve the problem? Now, I think for some of them, yes. Of course, as we discussed earlier, people have to want these assets. But then secondly, you need incentive systems in place to bootstrap the initial liquidity, right? And once you're able to do that, which I think crypto does very effectively, the goal is to distribute, right? So our vision with Hecto is not necessarily to build an asset that you have to be on Canton to buy, but a product that you can access from your retail brokerage account, a product that you can purchase on a centralized exchange. Denari here are one of the sponsors. They power US public equities trading from retail brokerage accounts. And people have no idea it's tokenized stock they're buying. I think this is the future, and it's certainly where we're pushing.
Answering your question and who will be the end buyers, I believe it's the end buyers of all the securities that they're having now. It's pension funds, it's sovereign wealth funds, it's large asset managers, because with better regulation that is coming, right? And the regulation in the US is catching up with a lot of European regulations. It's just easier to buy those tokenized assets. It's easier to have compliance check on that. It's verifiability and transparency of blockchain helps them to manage that. And as long as there is this regulator oversight that tells them that, okay, this is a true representation of an asset, I think those will be the ultimate buyers. It will not be the retail that is running after meme coins. It will be the institutional managers, basically.
Nikita, I have a question for you. Suppose you have $1 million. Will you put it anywhere which will only give you 3% a year? No, right? Because you're sitting in Dubai, people sitting in Singapore, and people sitting in New York have access to that 3%. Imagine you are a business owner in Nigeria, earning in Naira, where the Naira depreciates 10% every year, and you don't have access to US stability. If I'm giving you a US dollar stable yield of 6% a year, you will quickly take it. This is where mass market consumers will come. What Faraj said is true, you know, institutional money. This is the big guys. Pantera doesn't raise $6 billion to go do tokens. They actually land up at these big guys to give them 8%. But if I'm talking mass market, then we need to go to the down south, you know, the global south.
Very well said. So just to finish off the panel, in one sentence, what do we need to do for RWAs to actually succeed in 2026?
Basically, continue working with regulators to make it more transparent.
Privacy. Privacy unlocks the future.
Build real products.
I'd actually have to agree with Faraj here. I'd say continue working with the regulators.
Tokenize what people want.
And focus on the little guys.
Amazing. Thank you so much, everyone.